Hello, everybody, and welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the 1031 exchange or the DST are amazing ways for you to create and preserve more wealth or help your clients, friends, and families do the same. For those who don't know me, my name is Brett Swarts. I'm founder of Capital Gains Tax Solutions. In each episode, we're joined by some of the best real estate, financial, and business minds in the world, where they share their ideas, deal stories, and inspiration. So together, we make complex tax deferral strategies simple and passive income plans achievable. Hey, I'm excited about our next guest. He is out of the great state of Colorado, and he's been in the industry for many years, and he has a plethora of knowledge as it pertains to creating and preserving more wealth with 1031 exchanges. Now, you probably have heard of the 1031 exchange. If you've heard this podcast at all, we've talked about it extensively. And actually today, we're going to go a little bit deeper dive. We're going to get out of the basics, and we're going to dive into some of the exchange issues in today's market. Just overall, what's happening out there, and what are some of the challenges? And then Scott and I are going to geek out to try to give you some solutions to that. Please welcome to the show with me, Scott Saunders. Scott, how are you doing?
Hey, Brett, great to be with you. I'm doing great today. Excited to dive in. And, 1031s are such a powerful tool. Excited to kind of dive a little deeper, maybe share some things that some of your listeners have not heard before or maybe haven't considered. So really excited to be with you.
Absolutely. And for our listeners getting to know you for the first time, Scott, could you give us a little bit more about your story and your current focus?
Absolutely. I've been doing 1031 exchanges since 1988, a long time. In that, I've been on the board of directors of the National Trade Association, former president, really have kind of seen everything that takes place. And I spent some time today actually educating people in Congress as to why 1031 is a important tool in the tax code. It really helps create jobs. It helps create transactional activity. We had a study done just recently at Ernst & Young that showed it contributes something like $98 billion to the GDP. So at the end of the day, this is a tool that helps investors grow their portfolio, but it also helps the economy overall. And you're certainly using that, Brett. People relocate from one state to another, or they relocate their business, or they diversify their portfolio into growing markets. So it's just a great strategy, and great to be with you to talk about it today.
Absolutely. Scott, I believe we've all been given certain gifts in this life, and these gifts have been given us to be a blessing and help to others. I'm curious, if you go back to your younger self, what would you say one or two gifts you believe you were given, and how does that help how you help and bless people today?
I think one gift is I just understand economics and the tax code. Kind of geek out. I love doing that. And, a lot of people look at the tax code and they go, oh, tax. Nobody likes paying taxes. However, the flip side of that is we have this code that has all these great provisions that are nothing more than incentives to allocate capital. And so as an investor, if we look at some of those incentives that are put into the code, and then we allocate our capital towards those things, the code gets economic growth, the economy grows, and we as investors get a benefit from favorable provisions, 1031 being it. But you look today in the code, we've got provisions that help with green energy and renewable resources. And I think investors that are savvy will look at these things and say, hey, can I take advantage of some of the things Congress has put into the tax code as an incentive and put my money there? And I kind of accomplish two things. I get a better return on my investment, and then maybe we help move the economy in a bigger sense towards some bigger objectives.
Absolutely. So I love that, Scott. And so let's dive right in. What would you say the number one secret is to understanding some of the issues today with 1031 exchange in today's market?
One that I think is overlooked is just how broad a 1031 exchange is. You're certainly familiar with the Delaware Statutory Trust and what I call fractional ownership, a growing niche. But one thing that people overlook is you can exchange any type of real property. And that's so broad, right? We have people that do exchanges on air rights, what is known as a transferable development right. So if I'm in New York City and I got the right to add 5 stories to my building, that is literally an air right. And I can exchange out of that into an apartment complex. We do exchanges in many states, particularly the drier Western states, on water rights, which are considered real property. We do exchanges on easements of all different types. A conservation easement qualifies. An agricultural easement can qualify. And one that's called a perpetual communications easement, a little bit of a mouthful, Just think of it in English as a cell tower. If you've got a cell tower that you create a perpetual communication easement, you can keep your land and exchange out of that cell tower. If it's on a commercial building, you keep your building and exchange out of the cell tower. We do exchanges into energy. We do exchanges into certain oil, gas, and mineral rights are out of it. So 1031, when you look at it broadly, really applies to any real property held for investment or used in a business. And so sometimes people just kind of think of, well, I got to go from commercial to commercial, not realizing you've got all these other types of things that are considered real property that qualify, and I know you're an expert on Delaware statutory trust, where people either go into that as their entire replacement property, or we see a lot of people that maybe will have a little left over. They do an exchange out of $1 million asset. They've got 200,000 that would be cash boot. They just take that slice and go into a DST, right? So they get a little bit of diversification and they pay zero in capital gain taxes. They kick the can down the road on that.
Absolutely love it. And so we're talking with Scott Saunders with APIexchange.com. It's asset preservation. It's APIexchange.com is where you can find them. So Scott, you mentioned a couple of things. Curious on, today's market, right? We're seeing kind of an interest rate environment that's kind of rapidly going up, and maybe cap rates haven't necessarily risen as fast, right? Sellers still holding on to fixed rate loans. They're not necessarily wanting to trade for sellers who aren't necessarily lowering their price. And I'm curious if you're seeing that too, and what that means for someone who might be in a 1031, if they're going to be selling high and maybe putting themselves in a tough debt position.
Yeah, absolutely. We're seeing that in the marketplace. We haven't seen that capitulation that I think we all expect to happen to adjust to the higher rates. So there's a little bit of a standoff there. I think I'm seeing it beginning slowly. You're beginning to see the dam break a little bit, where there's a little bit of flexibility. Sometimes it may not be on price. Maybe it's on terms, right? So the seller is going to offer some terms to help make that deal a little more attractive. But the point being, you do bring up a great point. If you sell into the market and now you as a buyer are going to have to actually pick up new debt at these higher rates, that can be a little challenging. One way that we've seen, and I'm sure you've seen this in the marketplace as well, is maybe somebody will actually, instead of selling first, they'll purchase before they sell. So they'll lock in, they'll find a really good off-market deal. And that seller says, I need to sell right away. And they'll do what's called a reverse exchange, right? They'll buy that asset today, and that gives them 6 months to sell their existing property. So we are seeing investors take advantage of reverse exchanges when they get that really good off-market deal. And that's one where they can maybe negotiate. They got some built-in equity into that purchase right up front. So reverse exchange is something we're seeing people take advantage of right now.
I'm curious on the reverse exchange, because I've heard of it a lot. I just don't see it practiced a lot. And it seems like some of the challenges, Scott, is, hey, I need to have that down payment. I need to be, really, really wealthy and have extra cash and liquidity to be able to obtain that new loan at a new property, and then be able to sell the other one. So talk us through, some of those things, or help us overcome some of those false beliefs with the reverse exchange that maybe some people have out there.
Yeah. Well, when we call it a reverse, let's just define what it is. Reverse is I'm going to buy the replacement property before I sell the existing one. So you purchase it, and now you have 180 days to sell your existing asset. But interestingly enough, when we call it a reverse, there really are two different ways to do a reverse exchange. There's one, what we call parking title on the replacement property. And so this is what we call an exchange last format. We're going to tie up that purchased property and close on it, but we're not going to actually do the exchange until we sell the relinquished property within 6 months. In that format, you may not need to come up with as much of the cash up front. If you can get the seller to maybe do a short-term seller carryback, say 6 months, you come up, purchase the property, they carry back a note. When you sell your existing property, what we call the relinquished property, you then take all that cash, you pay off the seller financing, and then can wrap up the exchange. The other thing you can do too is you can cross-collateralize. You can borrow from other assets. If you're an investor and you've got a really good equity position in an asset, you do some short-term financing. You refi it short-term, pull that equity out to do the reverse exchange. So, Brett, you alluded to it. When you do a reverse exchange, you're going to have to come up with some cash to close on that purchase, right? And if it's all tied up in your relinquished property, you're either going to have it sitting from another source or be able to borrow against another property to do it. So some people can't do a reverse exchange if they don't have that liquidity. But, keep in mind, you don't have to do, we call it a reverse. We can park title on that replacement property or the relinquished property, which is called the exchange first format. So there are a couple ways to do it. This is where you want to get on the phone with your tax advisor and a really good qualified intermediary, and then look at your situation, right? What are the terms of the purchase? Do we have a conventional loan? Are we trying to do all cash? Can we have a short-term seller carryback? That might open up some options in a reverse exchange.
Excellent. We're talking with Scott Saunders, APIexchange.com, APIexchange.com. And Scott's been a part, by the way, since 1988, over 100,000 1031 or transactions in general, commercial real estate transactions, which is incredible to think about. So Scott, I want to take that expertise and I want to go back, right? It's 2003, 4, 5, 6, 7, right? We're doing the 1031 exchanges. People are building wealth. It's high fives because the values keep going up. At what point is it not a good idea to do a 1031 exchange? And if you had a chance to go back and do the Monday morning quarterback, I'm curious, would you have just sold everything at the peak, paid the tax, and reset the depreciation when the values dropped? What would you have done knowing what you know now?
Personally, I'm a little biased on this, Brett. I'd be hard pressed to not continue exchanging. So you brought up correctly, the one disadvantage of a 1031 is you're carrying that basis over. So unless you're exchanging up a lot in value, you're not going to get as much depreciation. So that is the negative. I would say right off the bat, the reason why someone should not do an exchange is they want to get out of real estate as an asset class. They decided they want other investments, alternatives, whatever it is, but they decide real estate is not where they want to be. That person, it might make sense to sell, pay the taxes, whether it was done now or in the early 2000s, take that money and move it into other investments. When you look at the time value of money, if you like real estate as an asset class, and I think most commercial investors like real estate, that they're deep into real estate. If you're going to keep reinvesting into more property, it rarely makes sense to not do a 1031 exchange because, as you know, you can exchange for one property. Well, you can do that over and over and over again. And then under today's tax laws, when you pass away, your heirs get it with a full step up in basis to the fair market value at the time you pass. So you've essentially not paid capital gains throughout your entire lifetime. You've got all this highly appreciated commercial property. You pass it on with a full step up in basis. Your heirs don't pay it. So to me, it's always advantageous to do a 1031 exchange as long as you're staying in real estate. What I would say probably makes sense to look at is to dovetail doing a 1031 with maybe a cost segregation study, right? Get the 1031 benefits for deferral when you dispose of an asset. Now, when you own an asset, you may be reclassifying, you pull some of that depreciation forward to today. I think, you're having me go back in history. If I look at where we're at now and I look forward, I think inflation is going to be with us as a variable we're all going to deal with. So if I can take my depreciation today and due to the time value of money, get more depreciation right now in 2023, that's better than me taking it over time, over that depreciation schedule. Now I use that tax savings to go out and buy more commercial property. I'm going to get ahead, I think, by combining those two strategies. So do you have any thoughts on that, Brett, from your viewpoint?
Yeah, I love all of that. I love using cost segged and especially with bonus depreciation this year, which is 80%. And I like what you said that if you're wanting to stay in real estate, then you'd stay in real estate. But I do want to play this out a little bit more, Scott. I'll push back a little bit. I was at Marcus and Millichap in Sacramento, right? And I started in 2006. And we learned about 1031 exchanges on about day 3 with asset preservation. You guys did a presentation. I love you guys. You guys are like the top of the industry. And but then the music stopped in 2008. And then I saw clients, friends, and family lose half or everything. And the main thing was they had too much debt, not enough liquidity, and they knew they were overpaying, Scott. I mean, they knew in 05, 06, they felt like something was, but they felt trapped by this capital gains tax. And they felt like the only way was to do the 1031. And they weren't diversified. They weren't liquid. And the music stopped, and some lost half, some lost everything. And it was sad to pick up the pieces. And Sacramento is one of those more boom and bust type of cities. And so looking back, we said, what would we have done differently? And knowing what you know now, it's the Monday morning quarterback, right? It took 3 years for the marketplace, especially for real estate, to see the bottom of values. So had you sold, let's just say early 2007, right, late 2006, paid all the tax, right, and waited for 3 years. I know this is the Monday morning quarterback, right, but rebought properties, and you wouldn't necessarily wait 3, you'd probably wait a year or two, or buy slowly, during that time period. To me, it's like that's the holy grail, right? But it's tough because the 1031, we've been taught swap until you drop, right, and get the stepped up basis. And yet I saw people swap and then they lost it all. It just dropped right there, right? And they got nothing, right? So walk me through, again, had you known what you know now, wouldn't you have just sold everything in 07, paid all the tax, and then waited until these values actually shifted to a place that made a lot more sense?
Well, let's put it this way. If you could ever time the market, be it the real estate market or stock market, I think everybody, if you could do that, which sounds great in theory, but it's not really possible in reality, you could probably get a better return, right, by selling at the very, very peak, taking your chips off the table, and then the market crashed. You could have bought assets for almost half of what they were at the peak. Yes, if I could in a perfect world, if I could do that. But here's the flip side of that. I live in reality, and it's really hard when you're in the market to know, is it the peak or not? Look at what we just went through with COVID. At the moment that hit in spring, a lot of people were going, wow, this is going to be a really, really big challenge. And yet what happened in some sectors, particularly on the residential side, prices were on a tear. So it's hard when you're in a market to know, am I at the peak? Am I at the bottom? And then to have the ability to move. So yes, if we could do that in the real estate market in Sacramento, that would be the ideal play. It's same thing with the stock market. If you can perfectly sell your stock. I mean, gosh, Brett, I once bought a stock that went up 40 times in value, but I never sold it. And it went right back to what I paid for it. So literally on paper, if I would have perfectly sold it, I would have crushed it. But I wrote it up and then I wrote it all the way back down. Why? Because I'm an investor, and you always think things are going to come back over time one way or the other. And we don't have all the information. We don't have the benefit of being able to look back. But I'll go with you on that. I'll say if you could perfectly time the Sacramento market, absolutely. But the one piece I'll give you, one data point. What about a diversified portfolio? So you're assuming someone in Sacramento. What if I bought in some of these markets that didn't go through as big of a boom or bust? I may not have had quite as much swing on that, So we've got markets now in the country, three states we all know of that are just booming incredibly: Florida, Tennessee, Texas. I don't see those trends in the short term changing. I think some of those economies are bringing in a lot of capital. What do they have in common? They've got zero state taxes, and they've got fairly business-friendly environments. So that's drawing a lot of capital in. So I think some of those trends would maybe what is a better suggestion is for an investor to diversify their commercial investments into maybe 2 or 3 markets. And maybe that'll provide a little bit of protection from some of these cycles. If you're spread out in a few markets, that way you have a market like Sacramento that goes up high and then crashes. Maybe you can insulate yourself and not have the big swings up and down quite as much. That's the thought.
I couldn't agree with you more. And by the way, we're talking with Scott Saunders, APIexchange.com. And I want to pull out a couple things there. It seems like timing is the crucial piece here, right? Like timing. Like if you had a gut instinct that, a year ago, we were probably at the height and the peak of the market, and that something could happen, the interest rates could change after trillions of dollars was pumped into the economy. And you bought that rate cap just to be cautious enough, right? Now the rate cap's expiring, and we're seeing some distress happening. That if you could time the market and have flexibility, also to diversify. I like how you put that, because stocks, this, and I'm not a big stock market person, right? I grew up in real estate. I love real estate. I'm the same way, especially value add, hands-on. Stocks seem to be, especially cryptocurrency, another thing. It's very volatile and it moves pretty fast, right? In fact, I think it was the down when '08 hit. I think the down from the stock market, I think within like 3 to 5 months was the bottom of that. Again, it took real estate. It's kind of like a big ship. It takes a little bit longer. It lags, right? And it also takes a little bit longer to get back. So you have a little more time in the sense of, okay, I think we're pretty much at that 10-year mark. We're at 12 years, we're at 13 years. Like, we kind of get the sense of that, that you could sell and diversify. To me, timing is the key part here, because then you unlock opportunity in a way that hopefully goes more in your favor. Which right now I just feel like debt is not in a lot of people's favor, right? Unless you can get it on terms from a seller. And by the way, if you can negotiate a carry back with a seller on good terms, fantastic. Those are nice deals. You don't have to deal with the bank typically, right? And you can maybe even get a better deal. But having that diversification, having the ability to be liquid, and having the ability to buy real estate at optimal timing, to me is foundational for building wealth. Anything else you want to add to that, Scott?
No, I would agree. Timing is great. I think a little diversification. Think of somebody now that's in Class A office space in a downtown market. That whole segment historically has been performed well. Life insurance companies own that asset class. But if you have everything in Class A office, you're going to be feeling some pain, in most markets, I think, just because of the dynamics of people not working as much and some challenges in some downtown areas. So diversify by maybe not only market, but maybe even diversify by the type of investment. Look at something like industrial, right, which has done fairly well. And I don't see any reason why it wouldn't. We're all going to have to store our goods in warehouses, regardless of how we buy it. If we don't go into a brick and mortar building and we buy it over Amazon or through the internet, you're still going to have to store those goods somewhere. So maybe having some diversification by asset class in addition to market is probably strong. And you know what? And I'm not a stock guy either, Brett. Right. I love real estate. I drank the Kool-Aid. I'm all in on real estate. I'm in 9 markets right now personally. So I practice what I preach. But diversification, where do you hear that? You hear with stocks, right? Build a mutual fund with a bunch of different assets to spread the risk. Frankly, I think the same thing applies to real estate, right? Diversify by market, diversify by asset class.
Could agree with you more, by the way. And I love industrial. I also love mobile home park. I love multifamily. I love RV space now too. RV is coming on, and multifamily. Those are my food groups right now. Yeah, you're right. Office is definitely be very cautious with that right now. I have a lot of clients that like hotels, but what I mostly like is value add, hands-on ability to control your destiny by adding value. One of the downsides with the Delaware Statutory Trust is the fact that typically there's a thing called the 7 deadly sins, where generally speaking, it's not a value add opportunity. Back in before the '08 crash, there was a lot of these ticks that came out that people did these fractional ownerships into. A lot of operators lost a lot of money, and a lot of people lost a lot there. And they've cleaned up a lot of that up, where the Delaware's now typically it's not value add, which is not great either, because now I'm giving up and I might diversify out of my multifamily property in Sacramento into like a Delaware Statutory Trust portfolio. However, they're kind of turnkey, right? I mean, they're beautiful properties in beautiful locations with first-class operators, tend to have huge fees, by the way. 10 to 15% of every dollar is getting knocked out. And so I go, what's the value of diversification? Definitely valuable, but also what's the value of liquidity? The one downside I see right now with the '08, what happened, and also right now what we're seeing is if you don't have liquidity and the ability to to be out of debt, because the 1031, one of the challenges too, Scott, let's be honest, is that it has to replace the debt, right? It's equal or greater value, which means equal or greater debt if you have debt on the asset. If you don't have debt, then that's different, right? And that can put you in a tough spot where if you have liquidity, diversification, the ability to go back into real estate at great timing or just diversify it, right? With operators that have value add opportunities versus just turnkey deals. Again, maybe I'm living in my own world here, Scott, but what am I missing if I could have all that?
A value add is certainly a better way to do that. But I will share with you something in the market. You mentioned correctly. What do you need to do for full deferral? Very simple. Reinvest all your net equity after closing costs, same or greater amount of debt. About 1/3 of our clients, Brett, do partially deferred exchanges. So they might replace the debt, but right now, because of the market, they might pull out 300-400 grand of equity, pay taxes on that. So they buy one replacement asset. They do a partially deferred exchange. It's called cash boot. They pay taxes on that. So we are seeing people kind of shore up their finances, saying, look, I may not do a fully deferred exchange. I'll do a partially deferred one, pay the taxes on the boot that they get. But guess what? They're just paying that on the boot that they receive. They still get the benefit of a 1031. Now they've got a little bit of cash in their bank account to help weather challenges that are coming in. Because if you look at this, we all saw the yield curve invert. I think a lot of people think that there's still decent odds of a recession of some sort. Why not build up your balance sheet now, right? Take a little bit of money off the table, take a little tax hit, and then put that cash aside to kind of weather the storm and be in a little bit of better position there.
I could agree with you more, except for the tax hit. We don't like the tax hit here at Capital Gains Tax Solutions. We want to provide multiple solutions, but I want to switch to a different tax though. And I think it's the elephant in the room, Scott. And I think you have some wisdom on this. According to Marcus and Millichap, John Shang, head of research, he said that there's an estimated $84 trillion that's set to pass from one generation to the next in the next 20 years. And this is known as the largest wealth transfer in the history of the planet. And in fact, 50% of the total net worth in America is tied to commercial real estate, high-end primary homes, and businesses, private equity, right? It's my understanding that the 1031 exchange only applies to investment real estate, essentially, right? Not primary homes or private equity businesses. But even more than that, even if it did, or you can somehow maintain a stepped up basis, it doesn't change the estate tax, right? So the estate tax, in other words, if you're worth more than 24 million married or 12 million single, essentially right now, that's set to cut in half, by the way, in 2026, it's subject to a 40% debt tax. So walk me through a scenario, Scott, where, you got a $100 million client. He owns apartment complexes, hotels. They're all inside of his taxable estate. He's not necessarily charitable giving. He doesn't want to buy a bunch of life insurance to try to offset it, right? And how's he going to get, he doesn't have 50 kids to gift it all away fast enough. How's he going to get it outside the taxable estate if he just waits in a 1031 and does a stepped up basis?
Somebody in that at those levels with today's, and I think you correctly point out, they're going to go down a lot more. So I think this issue is today in 2023 is a problem. When the thresholds are halved, just in a few short years, it's going to be an even bigger problem. The way you do that is you start gifting it away at the value of 100 million. I don't think that's going to be possible. I will just share with you a strategy, because you mentioned something there about primary residences. So let's look at somebody, La Jolla, California. They bought a house 30 years ago for 300 grand. Today it's worth $5 million. There is a provision in the code where you can actually convert that property that's your primary. You make it a rental property. You rent it out for, let's say, a year. Now you're going to convert that equity that was basically your primary residence. Let's say you're married. You use section 121 of the code, you exclude $500,000. There's $4.5 million of gain. Let's just say it's all gain. You can exchange out of that property. Now it's an investment property, and you could take that capital and go into another investment property, buy a small apartment complex for $4.5 million. So we are seeing people convert equity that's tied up in their residence. Both coasts, you've got, whether it's California, Oregon, Washington, New York, New Jersey, you've got a lot of markets that are seeing, $1, $2, $3, $4 million residences with a lot of equity. I think it's a great strategy to convert that residence that otherwise you're not going to be able to shelter, make it an investment property, then do a 1031 out into another investment property. So, Brett, I didn't solve your problem of the guy with 100 million. I think there are issues there. And frankly, looking at things like buying a life insurance policy to offset some of those things, you've got to look at other strategies at that level. You've got to look at other ways to be creative to reduce your tax hit. I think you have to do that. But I think I got a partial solution, converting that residence equity that's way over the caps of 121. Look at some creative strategies to make an investment property. We see people doing that all the time. Let's just say you got an investor that doesn't have a big commercial portfolio, but they've got that $4 or $5 million home. That might be their retirement income. If they can convert that over, then they exchange into an apartment complex. that kicks off their retirement cash flow. So at a little bit of smaller numbers, let's say we're looking at somebody $4, $5, $6 million net worth, not 100 million. Now you've got a viable strategy to use 1031, combine it with the 121 code, and really get ahead financially.
Absolutely. Yeah, that all sounds really good. But by the way, if you are single and worth more than 10 million as of 2026, then you have, and they're all signed state taxes, but you can have a $4 million estate tax problem, 40% of that 4 million, unless you're gifting away. So get with your estate planning attorney, get with a living trust attorney, and start to gift now, right? If you're running out of time, you're going to want to look for solutions beyond the 1031, because the 1031 will not save you for that. You'll get a stepped up basis. Cap gains tax are good to go, but estate tax will be 40%, basically within 6 months of you passing away. So be very aware of that. That being said, Scott, are you ready for the lightning round?
I'm ready. Fire away.
All right. Knowing what you know now, if you go back to your 25-year-old self, what's the one golden nugget make sure to tell yourself to do?
Oh, buy real estate and buy it faster and quicker.
Excellent. Question number 2, what's the number one book you've gifted or recommended the most in the past year?
Oh, you know what? I'm gonna be boring on this one. I've done Rich Dad, Poor Dad for teens to several teenagers.
Love that book. By the way, I just got the cash flow board game from Rich Dad Poor Dad, and it brings the book alive for the kids to play cash flow. So I play it with my kids, which is pretty cool.
That's so cool. By the way, I just bought two of those games. I'm giving one away to a friend and keeping one here. So great strategy.
And it's a great game for adults too. Everybody, right? We
Yeah.
can't be enough to remind ourselves to get cash flow and get it passive and to grow wealth. Question number 3, what are you most curious about right now?
Oh, I am most curious about the state of the economy and how are we going to see the central bank digital currency, and how fast does that get implemented? I know there are a lot of different perspectives on it. I have no idea, but I think it's coming. It's just a matter of what it looks like. And I think that's going to shake things up in a big way.
Amazing. Second to last question. What's the number one leadership quote or theme that you strive to live by, Scott?
Ooh, leadership quote. I'm a tax wonk guy. I like so I'm not going to be a leadership quote. There's a guy that said there are 2 tax codes, one for the informed and one for the uninformed. That came from Judge Learned Hand. Love that quote. And I think you and all your listeners are probably the ones that want to be in the informed category.
Absolutely. Last question, Scott. After all your success, over 100,000 transactions since 1988 with commercial real estate 1031 exchanges, and helping all the people you've helped to grow and create and preserve more wealth using the tax code in their favor, how do you stay centered in your values as well as stay encouraged to charge forward to reach even higher heights?
On values, I do the things I love. I just got back spending time with my daughter in the mountains. We're in the San Juan Mountains of Colorado. Nothing more fun than just dipping a fly line into the water, catching some fish and relaxing. So I think, as we're growing portfolios and doing that, we got to spend time with the people we love, doing the things we love.
Fantastic. Scott Saunders, has been more than a pleasure to get to know you a bit, sharing tons of wisdom with us, creative solutions for 1031 exchanges, especially in today's challenging market, and looking for creative ways to help your clients create and preserve more wealth. For our listeners who want to get in touch with you, would you mind one last time, what's the best place for them to find you?
Best way to find us is our toll-free number at Asset Preservation, 800-282-1031. You can always email me. It's just my name is Scott at apiexchange.com. Happy to be a resource to you and your listeners on anything related to 1031 exchanges.
Amazing. Thank you so much, Scott. I also want to thank all of our listeners for listening to another episode of the Capital Gains Tax Solutions podcast, as well as streaming on Expert CRE Secrets as well, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, not having a clear plan is the enemy, and using a proven tax deferral strategy such as the 1031 exchange or the DST is an amazing way for you to create and preserve more wealth. Here's the key. You want to be with a team of experts to help you through every stage of this. Scott is an absolute expert, so you want to check him out at apiexchange.com or call that number. And if we could be of any help to you to help you sort through what options are available for capital gains tax, 1031 exchanges, alternatives to 1031 exchanges, go to capitalgainstaxsolutions.com. So appreciate everyone watching out there. And by the way, check out the new book that just got released, Building a Capital Gains Tax Exit Plan. It's a proven playbook for unlocking your ideal wealth plan or selling assets of any kind for yourself or for your clients. We do have Kevin Harrington from Shark Tank in the book, and remember other really smart multifamily people, financial advisors. I got a couple chapters as well. Check that out on Amazon. So appreciate everyone out there.